Welcome to the Deep Dive, where we shortcut information overload and jump right into the core of complex topics. Today, we're drilling down into the rulebook for life and accident and sickness insurance agents in Canada. Specifically, we're focusing on the strict, non-negotiable client protections built right into their ethical codes and their licensing.
We're pulling apart sources that detail regulatory expectations around disclosure, compliance, professional conduct, the whole 9 yards. And if you're looking for the single unifying theme across all this material, it is really the fundamental obligation to ensure the fair treatment of clients. The entire system is built on mandatory, thorough disclosure.
So if you're buying a policy, these are the foundational rules that determine if that policy is a secure safeguard for your family or, frankly,
It's just an expensive piece of paper. Exactly.
Okay, let's unpack this. Our mission is to trace the flow of information and responsibility, starting right at the application phase. And here's where it gets really interesting, because what seems like a small favor or a simple omission can result in just catastrophic financial failure years down the road.
It's the very definition of utmost good faith. I mean, every piece of information on a life insurance application, particularly health information, has a direct bearing on whether the policy is issued.
Or the rate they'll give you.
Or the rate, or whether it's rejected outright. The contract's validity, it hinges on the truthfulness of those statements.
The sources highlight a classic ethical pressure point. The agent is often tempted to withhold crucial details, usually believing they are helping the client. They might think, if I disclose this, the client will pay a higher premium, or maybe they won't get coverage at all. I'll just leave it out.
And that perceived act of kindness is precisely the ethical and regulatory failure. We see a powerful teaching example in the case of Nabila, the agent, and Leslie, the client. Leslie has a pre-existing health condition. Nabila knows that disclosing this condition will trigger what they call a rated premium.
Meaning higher payment.
Higher payments, yes. Yeah. And she worries Leslie will just walk away without coverage if that happens.
So Nabila decides a flawed, cheaper policy is better than no policy, and she omits the health detail. Leslie signs, thinking she's protected her mortgage.
Exactly. Nabila secures the quick sale and Leslie gets the coverage, but the underlying foundation of the contract is already compromised. Sadly, upon Leslie's death, the insurer investigates, which they have a right to do, by the way.
Especially early on.
Especially during that 2-year contestability period. And they discover the material omission regarding her health history.
Because that information was so critical?
Yeah.
So critical that the insurer wouldn't have offered the policy on those same terms if they had known the truth.
Yeah.
They can just void the contract.
That's the tragic outcome. Instead of paying out hundreds of thousands of dollars to cover the mortgage as expected, the insurer is legally justified in returning only the premiums Leslie had paid.
Wow.
That move, made by Nabila out of this, perceived kindness, turned the insurance from a promise into a tragedy. Leslie's beneficiaries were forced to sell the house.
That story just hits hard. It underscores that the agent's duty is not just to get the client a policy, but to get them a valid, unchallengeable policy.
The duty of full disclosure trumps everything. It trumps an agent's personal judgment about what's best in the short term. It's the non-negotiable standard.
So, if the first pillar of protection is the client's full disclosure, the second must be the agent's disclosure. We need to know who we're dealing with, who they represent, and, crucially, how they get paid.
This is all about transparency and avoiding conflicts of interest. The agent must document that they provided all this to the client and keep proof in the client file.
Okay, so what's the first pillar of their disclosure?
The first pillar is licensing and affiliation. The client has to know who the agent is working for. So the agent must disclose, 1, the provinces where they are licensed to sell.
Okay.
2, the specific insurer or insurers they represent. And 3, the nature of their relationship with those insurers.
Meaning, are they tied to one company or are they a broker?
Exactly. Are they captive or independent? This tells you, the listener, if the agent might have a bias toward one specific product line.
That makes a lot of sense. So what's the second pillar?
The second pillar is compensation transparency, and this really gets at the potential conflict of interest when an agent's wallet gets involved. They have to clearly disclose exactly how they are compensated, their base commission. But critically, they must also disclose if they are eligible for additional compensation.
So you're talking about things like a travel incentive or a volume bonus. How does telling me about that actually change my decision? Isn't that just bureaucracy?
It absolutely matters because it speaks to influence. The agent must disclose if they qualify for cash or non-monetary incentives, like those trips or bonuses, based on the sheer volume of business they place with a company.
Ah, so you can judge if their recommendation is really about your needs or about them hitting a bonus tier.
Precisely. It's about identifying hidden incentives that might sway the advice.
And the final pillar of disclosure.
The final pillar is client rights and conflict management. They have to disclose any actual or potential conflicts of interest. And finally, they must inform you, the client, that you have the explicit right to ask for more information. It's an open door for full transparency.
Those pillars are vital. Now, let's talk about a situation where the risks for the client are exceptionally high. Policy replacement. If I already have insurance, why is replacing it so dangerous?
Well, the risk is high because you lose accrued benefits. You might lose grandfathered status on an old, highly favorable policy. You restart the contestability period.
So the insurer gets another 2 years to investigate you.
Right. And most commonly, if your health has changed since you bought the first policy, you might be denied the new one or face drastically higher rates.
So an agent recommending a replacement has to navigate this minefield of potential client harm.
They do. And to standardize this critical consumer protection, Canadian regulatory authorities mandate the use of a specific document.
And that's the Life Insurance Replacement Declaration,
Yeah.
right? The LIE form.
The LRD, exactly. It's the regulator's tool to combat policy-churning unnecessary replacement just to generate a new commission. This form requires the agent to provide a written comparative explanation detailing the advantages and the disadvantages of the replacement.
We see the ethical test this creates in the scenario of Roberto and Anne. Anne wants to increase her coverage from $100,000 to $250,000, and she's rushing because she wants to use her $40,000 in cash value to help pay for it before leaving on vacation.
Roberto faces intense pressure here. Replacement is usually detrimental, and Anne is impatient. But he knows the rules. He correctly informs Anne that regulations, specifically the LIOD process, require him to discuss the situation thoroughly and provide a detailed written summary before moving forward.
It sounds like the framework forces the agent to risk losing a sale just to follow a crucial paper trail. Is that where complaints come from?
Often, yes. The ethical agent prioritizes the mandate of written disclosure over the client's desire for speed. Roberto showed professional integrity by prioritizing the mandated LIRD process over the quick, feel-good sale.
Let's pivot back to money, specifically arrangements that might involve paying other people. What's the difference between sharing a commission and paying a referral fee?
They are completely different regulatory animals. Commission sharing is based on a percentage of the commission earned on a sale.
So the payment is tied to the sale itself.
Directly. And because of that, the recipient must be licensed to receive that split.
And we have the classic example of what happens when that's done secretly. Fidos and Fred.
Exactly. Fidos, an unlicensed real estate agent, refers Martha to Fred, a licensed insurance agent. Fred secretly promises Fidos 50% of the commission. Martha buys the insurance, but that secret split is unethical. It's a significant, undisclosed conflict of interest.
Okay, so commission splits are percentage-based and require a license. What about just generating leads? That's where referral fees come in.
Correct. Referral fees are paid for a name or prospect, regardless of whether a sale occurs. This is the key. The payment cannot be contingent upon a sale or be a percentage of the commission. It has to be a flat fee.
So if an agent pays a real estate agent a flat $100 for every client name, that's generally okay as long as certain conditions are met.
Yes. The primary condition is twofold. First, the agent must verify that the third party didn't engage in any insurance activities. And second, a written disclosure of that fee must be provided to the client.
And the regulators keep an eye on how big that fee is.
They do. While referral fees are acceptable, they should be nominal in nature. The moment those fees get too high, they start to look less like a finder's fee and more like a hidden commission split.
The ethics of the sale rely on the compliance of the professional. Let's look at the 3 critical professional safety nets, starting with errors and omissions coverage.
Errors and omissions, or E&O, is mandatory professional liability insurance. You can think of it as indemnity for financial loss that stems from negligence, mistakes, or oversights, genuine mistakes.
But this is a critical distinction, right? E&O covers mistakes, but it absolutely does not cover malice.
That's the vital limitation. E&O coverage does not apply to intentional acts, misappropriations of funds, outright fraud, or criminal activities like forgery. It's a safety net for errors, not a shield for crime.
But I understand some jurisdictions have introduced a slight modification to address the victim of fraud.
That's right. Places like Alberta and Ontario mandate additional coverage specifically for client loss resulting from an agent's fraudulent acts. The client is protected even if the agent's criminal behavior isn't covered by their own policy.
And for those who are leaving the industry, the safety net can't just disappear the moment they retire.
No. Agents must maintain uninterrupted coverage, and those retiring must arrange for extended runoff insurance. A client might only discover an error years after the agent has stopped practicing, and they still need recourse.
The second compliance duty is documentation. Why is detailed note-taking so important?
Because if a complaint or a lawsuit arises, those detailed notes, the LIE form, the correspondence, the recommendations, that's the agent's only defense.
So if an agent, let's call him Tuanan, is hit with a claim of misrepresentation years later, he needs those files to prove exactly what was discussed and when.
That's it. This detailed audit trail is designed to protect the client by ensuring accountability, but it also protects the honest agent.
That makes perfect sense. Finally, we have the contract delivery duty. This feels like the ultimate non-negotiable final checkpoint.
It is the last chance for the agent to ensure the integrity of the contract. Upon policy delivery, the agent must check and confirm if the client's health status has significantly changed since the application was signed.
So if you meet your client to deliver their finalized contract, you have to ask them if anything major has happened to their health in the last few weeks.
Exactly. If the client reveals a new, serious diagnosis, you are immediately obligated to stop the policy delivery. You cannot hand over the contract.
Because the policy was underwritten based on old information.
The information is no longer valid. You have to update the application and resubmit it to the insurer for reevaluation. It's about ensuring good faith right up to the moment the policy takes effect.
All these high-stakes rules, they all stem from the licensing system itself, which is the public's primary protection.
The licensing process is the gateway. Agents must hold a valid license in every province or territory where they conduct business. And to qualify, new applicants have to complete the Life License Qualification Program, the LLQP.
And the LLQP comes in two flavors.
Yes. There's the full LLQP, which qualifies an agent for life insurance and accident and sickness, or ANS, policies. Then there's an ANS-only license.
Let's clarify one thing there, because this often confuses people. Annuities and segregated funds, those sound like investments. Why does a life insurance license cover them?
That's because segregated funds are technically insurance contracts. They're investment vehicles wrapped in a guarantee provided by an insurer. That link places them squarely under the regulatory purview of the LLQP.
As opposed to traditional investments like stocks or mutual funds.
Which require a separate securities license. Correct.
And if an agent in Quebec sells a policy to a client who then moves to Alberta, how is that managed?
Canada handles this through a reliance model of reciprocal licensing. Regulators have harmonized their standards application forms, continuing ed, E&O requirements, so agents can license across multiple provinces without taking dozens of exams. It maintains a common standard of public protection everywhere.
And what happens when an agent breaches that standard?
The regulatory authorities maintain extensive records. If an agent commits a fraudulent act, makes material misstatements, or is just shown to be incompetent, their license can be suspended or permanently revoked.
And revocation is a career-ending event.
It is. Regaining a license after that is extremely difficult.
It's also vital for the listener to know their life agent's license has firm boundaries. What activities explicitly require a separate license?
A life agent's license is very specific. They cannot sell property and casualty insurance, like your car or home insurance. They cannot sell securities, like stocks, bonds, or standalone mutual funds. And they can't engage in mortgage brokering. All require separate licensing.
And there's a growing movement to protect financial titles, too.
Absolutely. Agents have to be extremely careful about what they call themselves. You can't just call yourself a financial planner or financial advisor. Jurisdictions like Ontario now restrict these titles only to those who hold specific, recognized credentials.
If we connect all these threads together, from the LRID form to mandatory E&O, the bigger picture is clear. The entire regulatory design is meant to shift risk away from the consumer.
That is the ultimate synthesis. The agent is strictly responsible for providing full context, ensuring documentation, and maintaining continuous compliance. It's a deliberate attempt to build trust across the industry.
What stands out here is how the regulatory framework, the paperwork, the documentation, isn't just bureaucracy. It's this shield that protects the client from poor judgment or a rushed sale. For you, the listener, understanding these rules means you know exactly what information you have the right to demand in writing. Consider the strict rules around fraud and intentional acts not being covered by E&O. Since the system places such a heavy emphasis on documentation and proof, those detailed files to needed. Does the detailed audit trail, designed to catch ethical missteps, inadvertently make the honest agent more vulnerable to constant scrutiny, even as it protects the public? Something to think about as you review your next policy statement.